Hi, my name is Stuart and welcome to the Investopoly podcast. My goal is to share easy to understand, evidence-based holistic insights to help you master the game of building wealth. And in today's episode, I'd like to pose the question, are you been or have you been to risk adverse? There's a cohort of people, a lot of Australians, spend most of their life reducing financial risk rather than becoming comfortable with financial risk. And I thought it would be a really interesting topic to discuss because risk isn't really the right word. It's really just about understanding more so than risk. So if you think about it, a common sort of approach or common financial decisions that people make is that they go and buy their first home. Tends to be a bit of a start. It's never their forever home. Now they might keep that or they might sell it and upgrade, but eventually the aim is to eventually get into the area or the type of property that you foresee that you're going to perhaps raise a family in or at least spend the foreseeable future in. And the strategy is to obviously try and get to that point and then to really focus on repaying debt. And you might do that in sort of a couple of steps. So for example, you might go and buy a property, focus on debt repayment, so build equity in that property, sell it, go and borrow a bunch more money, and then again spend the next 5 to 10 years really focusing on repaying debt. The problem with that approach, or one of the side effects of that approach, is that you get very used to focusing on deleveraging, focusing on just reduce risk. And, a lot of people think, well, I'd like to invest, but, I just don't feel comfortable. I really want to get rid of this home loan. And, some people to the point will focus on that until it's zero. Like they won't even contemplate making additional investments until their home loan is completely repaid. And that's fine, but there's an opportunity cost. And I guess there's no right or wrong here. I think it's about sort of reflecting and understanding, what is risk and what is risky, and also what can you do to make yourself feel like it's less risky, because I think that's really, the answer lies in that approach more often than not. And as I've said before in this podcast, I think most people have a very similar risk profile. Safety and security are kind of basic human needs. We all want to feel financially safe and financially secure. Uncertainty makes people feel uncomfortable, so we don't want money worries or anything like that. And so really what we want to aim for is first to achieve a basic level of financial security. And then the next goal is really to have control over how we spend our time. So really work as much as we want, not needing necessarily to work. So if I feel like, okay, I want to work 3 days a week now and go part-time, that I've got the choices in life in order to do that. And most people realize that they don't want to take unacceptable or unacceptably high investment risk to achieve that goal. Most individuals realize that all they need is sort of average returns over a very long period of time. And if they're able to achieve that, that'll help them achieve their financial lifestyle goals. They don't need to aim for 20% compounding returns, is I guess what I'm saying. And so for instance, if you can get a 7.2% growth rate on an investment, it will double every 10 years, which is a pretty good result. So whether that's income or capital growth, it's whatever it is after tax. Of course, you don't pay tax on capital growth until you sell the asset, but whatever it is, even if it's income and it's 7.2 after tax, your investment will double in value every 10 years. So you hold those investments for 20 years, you're going to build wealth. That's all you really need to aim for in terms of investment returns. And so that's why I think people have, people realize that, and that's why I think they have very similar risk profiles. In essence, you can probably describe it as people are most comfortable minimizing as much risk as possible to achieve an average return over the long run. To put it differently, fewer inclined to take excessive or high risk just for the sake of pursuing an unrealistically high investment return. So that is, let's take as little risk as possible so I've got very small chance of actually losing capital. As long as I'm going to earn 7 or 8% compounding over the next 20 years, my investment strategy is going to work. So then let's talk about risk. What is risk? Well, I think we can define risk as just not achieving the returns that you're hoping or needing to achieve in order to make your plan work. And that might happen for a couple of different reasons. Firstly, you might make a mistake. It could be a dud investment, low quality, it was never going to work from the beginning, it's a mistake. Or secondly, and probably more commonly, hopefully, just the inherent fluctuations in the market, in terms of the distribution of returns. Property is a perfect example. Property in Melbourne over the last 7 years has underperformed every other state. Doesn't mean Melbourne doesn't work as an investment location or geography. Of course, long term it's going to work. It just means the distribution of the returns, very few have come over the last 7 years. But if we hold out for over the next 30 years, I'm sure we'll be fine. So then let's talk about those two situations individually. So first, make a mistake and just general volatility. Mistakes, I've always said, which is kind of the reason that I wrote the book Investopoly, of course this podcast is named after the book, is that very few mistakes are the result of just random bad luck. I think that's really important to understand because I think a lot of investors that lose money on investments, they tell themselves that, oh, maybe I was just a bit unlucky or the timing was unlucky or something like that. There's no luck involved. If you adhere to, certain rules and principles that are often evidence-based and rules-based approach, the likelihood of making a mistake is very low. And it's the reason why I wrote Investopoly, to sort of set out the rules that you need to follow to make really smart financial decisions. So that's putting to bed one of the risky side to investing, which is I'm going to make a mistake. That's easy to mitigate because I'm just going to follow the sort of evidence-based, rules-based approach, get advice, etc., etc. I can easily mitigate that risk. Let's talk about volatility then. Of course, volatility is natural and volatility is more about timing than anything else. Assuming that the investment fundamentals are sound, it's a good investment, then it's really just about waiting a little bit of a longer time. The share market has a reputation for being highly volatile, and you look at statistically, 95% of the time, your annual return if you invest in the share market will be between a loss of 30% or a gain of 50%, which is a huge range, right? You're either got a really terrible year or a really fantastic year. The difficult thing is to try and predict when those returns will happen and what will the return be over the next 12 months. But when you look at average returns over multi-decade periods, they start to become a lot less volatile and a lot more predictable. So if you're going to invest in the share market for 30 years, irrespective of when you actually invest, so whether it's before a crash or after a crash, your return's going to be probably close to 10% based on history. And so that's why volatility is really only important in the short term if you need to interrupt your investment strategy. So let's say I'm going to go invest in the share market. I'm going to hold those investments for 30 years, but in 5 years' time, something happens and I'm forced to sell those investments. That's when volatility matters. But if I implement a strategy that accommodates some of those risks and that is not too ambitious and conservative enough so that I can weather any storms, that I don't have to interrupt an investment strategy, I can hang on to those investments for as long as I intended to do so, then volatility doesn't really matter. Just close your eyes. Don't look at the balance. Certainly don't look at it on a daily basis. It will work if you follow a rules-based approach. And so that's why I think it's not really around risk appetite. It's really just an education piece rather than a risk mitigation situation. If everyone kind of understands, well, here's my two main risks, make a mistake or volatility. Well, there's a very clear and evidence-based path to avoid making a mistake. And then if you realize, well, volatility doesn't really matter. If I'm investing in super, for example, and I'm in my 30s, I can't access that super until I'm 60, 30 years time. Who cares what the returns are in the next 12 months? I just really want to maximize the average return over the next 30 years. And there's an evidence-based approach in order to do that. And that evidence-based approach suggests that you should just invest it all in equities because equities will beat all other asset classes like bonds and fixed interest and so forth over the next 30 years. Now, that's a high volatility approach. That portfolio is going to have higher volatility, but also over a 30-year period, it's going to have higher returns as well. Now, I'm not suggesting you should go and change your asset allocation, your super, and do that. I mean, you might, but not off the back of this podcast, of course. It's really just trying to educate you about, what is really risk, what are you concerned of, and as long as you don't need to interrupt the investment strategy, as long as you don't make a silly mistake, then you're fine. It's really about understanding how the investments work and understanding really what risk is. And it's not that risky to have a poor return one year if your investment horizon is 20 plus years, for instance. Now, of course, it's true that some individuals do have an exceptionally low tolerance for risk, and some individuals shouldn't be investing much in the share market and they should be really conservative and so on and so forth if their financial position allows them to be that conservative. But they're certainly the minority. I would say the majority of people are willing to understand markets, willing to understand volatility, and the evidence-based approach, I think, resonates with them. And then they just think, okay, if this is the approach that's proven to work, that's all I really care about. And so long as that pot of gold or that pot of money is going to be there when I retire at age 60 or 65, whatever it might be, I'm pretty comfortable with riding the highs and lows from one year to the next over the next 10, 20, 30 years, whatever it might be. So if you are concerned about risk, what can you do? And I'll give you 3 tips that I thought I'd share today about what you could possibly do to try and make yourself feel more comfortable about beginning or continuing your investment journey. Firstly, I think every sound investment market or methodology should be able to be explained in very simple terms. You don't need to become a financial markets expert. Most things are rooted in just basic concepts, logic, common sense, right? And so they should be easy to explain, and in simple terms. Now, you might not know the intricacies of a particular strategy or investment or whatever, you don't really need to. If you're getting advice, you just need to know just generally, broadly, how do things work. And that's what I've tried to do in the book Investopoly, is just explain those basic principles. And so a little bit of education goes a very long way, I think, in terms of allaying concerns around what might be perceived as a risky investment strategy or a risky investment. The second thing is get advice, of course. I think the big thing with getting professional advice is that you're leveraging someone else's experience. And knowledge is powerful, but experience tells us how and when to apply that knowledge. And there's no fast track to experience, right? If someone's got 30 years of experience in investing, they're almost always going to be better and provide more valuable advice than someone that's got 3 years of experience. And obviously anyone would realize this, because the same would be true in your profession. If someone's been in your profession for 30 years, of course they're going to have the knowledge and skill and insights that someone new to the industry wouldn't be. And that's what you're paying for when you're getting professional advice. You're paying for lots of things, but one of them is really leveraging that person's individual experience. And the final tip is just start. Like, if you're really worried about investing in the share market because you've never done it before, and you own some investment properties, but you really realize you need to start diversifying, well, just start investing in shares just a little bit. You'll start to become a little bit more confident as time goes on. Invest $500 a month and then just see how that goes for the next year. And if you feel more comfortable, increase it if you've got the capacity to be able to do so. But just the starting can stop most people. And once you see how the investment is working and the market fluctuations and these sorts of things, I think naturally it's going to build confidence. Now, of course, there's a huge opportunity cost of not taking enough risk throughout your working life. If you don't take enough risks, if you don't actively invest and so forth, and just focus on debt reduction, for instance, the risk is that you might not have enough assets by the time you get to retirement, or the risk is that you don't leave yourself enough time to acquire those assets, and which might force you actually, ironically, to take more risk. The longer time horizon you have, so the earlier you start, the less return you need in order to achieve your goals, and therefore the less risk that you need to take. So whilst a lot of people might spend a lot of their life de-risking themselves, repaying debt, trying to own their own home without any mortgage, of course, embracing risk, I think, is essential. And it's not really embracing risk, because once we really understand what risk means and then take steps to mitigate some of those perceived risks, ultimately we're actually taking a lower risk strategy, actively investing and building wealth for the future. So I guess I'd leave you with one question. Are you taking enough risk in your own personal financial situation? And it's something for you to perhaps think about. Now, it'd be remiss of me not to mention, because I mentioned the book a couple of times, there is a discount code in the show notes that allows you to buy it for $20, no postage. So if that's of interest, certainly check that out. And until next week, bye for now.